On today's show, should you buy the dip, sell, or wait? Why these stocks are crashing even more so than the market, where we stand with sentiment and what it means for price action for the rest of December, and why the US economy keeps on roaring. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks rebounded on Thursday from the previous day's sell-off that was fueled by a hawkish outlook from the Federal Reserve on its path for interest rates. Instead of 3 interest rates, guys, we are now getting 2 in 2025, according to the Fed's economic projections. And we actually saw a very green day, but a very mixed day in certain sectors. I mean, if you look at healthcare, very, very mixed across the board. That's because they were slightly positive yesterday, especially healthcare plans, relatively speaking to the market. And again, you look at stuff like real estate, energy, right? Very mixed action across the board. Same here with basic materials, consumer defensives, as well as industrials. However, there were some very green sectors as well. Financials, I mean, very, very positive, particularly the big names, Berkshire, JP Morgan, Visa, MasterCard, American Express. They were very green. That really did lift the financial sector. Semiconductors were mixed. I mean, Nvidia gained on the back of the mega caps running. Look at Microsoft, Apple, Amazon, Google, Meta. They were all positive. Nvidia followed suit. But the broad semiconductor market, right? AVGO, AMD, Qualcomm, they all fell on the back of Micron's earnings. Micron was down 16%, and Micron's earnings pretty much goes to show the bifurcated market still in the semi-trade where AI data centers is leading the charge. However, all of tech was positive. Most of software was kind of positive. Infrastructure was very positive. And this led to an overall day that was exceptionally positive. The S&P 500 bouncing back after yesterday's 2.5% decline, climbing 0.4%. A fairly positive day, all things considered. Now, utilities were actually the best performing sector, followed by financials and then tech, up 1%, 0.7% and 0.57% respectively. But we also saw communications, discretionary and industrials in the fold. However, they underperformed the S&P 500 in aggregate. Sectors that lost today were staples, energy, healthcare, materials, and real estate. So pretty much anything tied to commodities, anything tied to the Trump administration, or anything tied to rates actually fell because we did see some pretty vicious movement in the rate market today as well. And guys, the best sector to be invested in today was certainly mid caps across the board. But if you actually just look at the large component here of small, mids, and large, they did very, very well. And it was sort of like the value and core segments of the market that were actually pretty red. I mean, even look at the mid cap components, right? Only up 0.03, 0.06, pretty much a flat day. So we saw value and core pretty much lose today and growth gains. And so the underlying market is still feeling that churn, and that's very evident in market breadth. You can see this is the market average breadth. Now, this is the S&P 1500 equal weighted, guys. So this isn't market cap weighted. This is just all stocks equal weighted. Where do they stand right now? And right now, only 45% of stocks are above their 100-day moving average. Not a good look. The very long-term moving averages continue to remain intact. However, they are at risk. You can see the 150-day just flirting with the 50% mark. Stocks above their 150-day is just at 50%. And we see the shorter term averages and the longer term averages continue to decline. However, look at the 5-day right here. We did see a very, very mild improvement in the 5-day moving average, as well as the 20-day compared to yesterday, the 50-day compared to yesterday, and then the 100-day as well. However, all things considered, we are below the 50% mark. Not a good look. And if we start to lose these averages, we could actually see a prolonged sell into the market. Now, also what didn't help sentiment today was Micron's earnings. Now, the stock actually nosedived 16%. It was a very rough day for Micron investors. At one point down as much as 19% 3% after issuing weaker than expected February guidance despite rising AI chip demand. The memory maker, a key supplier to Nvidia, forecasted revenue of $7.7 to $8.1 billion, far below Wall Street's estimates of $9 billion. And this underscores a broad industry shift. AI chip sales are booming while traditional chip markets are slumping. Micron saw over 50% of its growth in its high bandwidth memory chip sales last quarter, driven by Nvidia's Blackwell GPUs, even as mobile chip revenues dropped 19%. With AI workloads surging, Blackwell demand is set to skyrocket next year, so AI couldn't even save Micron's stock. And look, when evaluating this stock, you have to price in all of the AI side plus the normal memory side, and those two together means we're going to see weaker guidance because we're seeing significant drops in traditional memory versus AI. So could this be a buying opportunity? Potentially. You'd have to look into it and maybe get a good price and probably expect a very weak quarter up until the next quarter. What also was sour on sentiment today was Lennar. Now, Lennar missed earnings, missed revenue, missed guidance as well. It was very, very ugly. They were only down 4.63% today, but that's because they were down about 15% in the last 3 months. Now, this quarter's performance was directly hit by a lag in home sales pace due to high mortgage rates as well as a low average selling price. This is largely due to housing affordability, and also new orders during the quarter showcased a downtrend. So very, very ugly earnings. And when you put all of these things together, it's going to hit the top line. It's also going to hit the bottom line because these home builders also need to offer so many incentives to get a home built. And that's why you're seeing very ugly price action in Lennar post earnings and for the last 3 months. And if mortgage rates continue the way they have in the last couple of weeks, and we're going to talk about rates, and they continue to move higher, it's not going to look good for home builders in 2020. Now, looking at data, guys, and despite all of the commotion we saw, data today was actually very, very good. Now, GDP growth, this is the final revision for the third quarter, came in at 3.1%. That is the official growth rate. Now, the consensus was actually expecting 2.8%. So that is a pretty big beat. And to actually see the price action we saw in equities today after a revision upside, a really good revision, really goes to show the sour sentiment underneath the market. I mean, on a day like today, you should see the S&P 500 up 1.5% on those growth numbers. Simply not the case. Initial jobless claims also came in better than expected, 220,000 versus the consensus of 230. And we also saw positive revisions to last week's data. Existing home sales also beat 4.15 million versus the consensus of 4 million. And we saw a month-over-month growth rate of existing home sales, 4.8%. This is a really good data point, but it's also probably affecting home builders because new homes aren't getting built as such. The market really just opting to get an existing home. Maybe that's more affordable in this current market environment. And for all of that, guys, and then looking at how this affected the overall picture for rates, the median forecast in the FOMC projections yesterday was for 2 rate cuts in 2025. The markets are ever cautious and now only pricing in 1 after the December 19 forecast. So we're only looking at 125 basis point worth of a rate cut next year. And pretty much what this means is that from now on, every single inflation report, employment report, or data print is going to be very, very crucial. The Fed's going to be hyper reactive to it, and so too is the market. And so we really have to start paying attention to the data that we get over the next couple of weeks. But let's hop on the charts. And looking at the charts, guys, the S&P 500, the only positive index here of the bunch, up 0.23%. Everything else is pretty much in the red. I mean, mid caps are kind of flat. The RSP is flat. The IWM down 0.1%. The market isn't closed. It closes in about 10 minutes, guys. And then the NASDAQ 100 down 0.1% as well. So, despite the very positive data we got today, market's still feeling angst after yesterday's FOMC, the market repricing. Rates actually did increase today, as well as the earnings picture from Micron. Not a good look in terms of the market, and we're going to continue to see churn. And guys, to me, this right now that we're seeing right now, this just looks like a dead cat bounce. Okay, we did see some buying, yes, don't get me wrong, it's green day for the S&P 500, but we also did see some selling at the highs right here. So just feels like a dead cat bounce. I'll probably only feel secure about this market once we go ahead and recapture the gamma flip and be in positive gamma. That's when I will say, hey, look, now is probably a time to add exposure for us to look to all-time highs and the core resistance. But to me, this just looks like a dead cat bounce. It sort of just looks like short coverings, people taking a bit of profits, the market taking a bit of money off the table, and we probably will resume the downtrend. If not, just consolidate at these levels right here for the S&P 500. Now, today's price action was coupled with the fact that we actually saw yields rise, except the 2-year yield. The 2-year yield fell, the 10-year and 30-year yield rose, the dollar gained ever so slightly, and then bonds actually fell as well. So bonds are not the safe haven bet anymore. They sort of just track what equities are doing. We saw gold. Gold was up 0.5%. So again, that really does signal to us that the market is getting a bit cautious, and the safe haven they're choosing is gold. People don't really want risk assets in the environment right now. A hawkish Fed, the market doesn't really want to be a part of that. And that is on the back of some very positive economic data. We got positive labor market data with initial jobless claims, positive economic growth data with GDP, and positive home sales data. And the market is still doing what it's doing right now. And that is rotating into stuff like gold and out of stuff like equities. And we're actually starting to see the S&P 500 in just a couple of minutes went from 0.24% to pretty much flat on the day. The Nasdaq 100 now down 0.4%, the IWM down 0.4%. Guys, so this, I wouldn't even say this is a dead cat bounce. This is just a continuation of selling we saw yesterday. And if we look at the candle we're looking at right now, this is the S&P 500. Yes, we did see some very relentless buying to the highs right here. Don't get me wrong. However, we actually saw sellers take us all the way back to yesterday's close, and this is where we're at for the low of the day at the put support. Now, we are holding this level. Don't get me wrong. We are holding the 58.60 level, and that is an equal low relative to this low, as well as the earnings gap up. However, if we actually go ahead and break this put support level, it just opens up this gap, and this is the Trump election gap. So from here, if we then go ahead, break below, we would then retest the put support, and if we then see a failed retest, we would then probably go all the way and close this gap at the 5800 level. And if we actually take a measured move as to where that will take us to, we're looking at probably another 1.5% downside, and then to the lows of that gap up, you're looking at about 2.7, maybe as much as 3% if the markets were to really get on with it. But there's still very much clear sellers. There's angst and anxiety, fear in this market, because we did move higher, but we couldn't even get close to the gamma flip, and we're now trading here at the put support, which is just yesterday's lows. It means the S&P 500 is flat, and then if you look at something like the Nasdaq 100, we're actually trading below yesterday's lows. We're actually slightly below the put support. We'll see what the support looks like at these levels, but things not looking that good for the Nasdaq 100, and looking at the RTY, not looking that good either. However, we're trading right here at the put support as well. So that is where we close. This is where we currently are. That represents 0.3, or in the IWM, the actual ETF, 0.43%. The futures are a little bit different, and you can see right here, again, consolidation at the put support. However, the thing is, if we are to break below this put support, it really opens up this level right here, the 2080 level. That is really the next support level, because what we're doing at this juncture right here is actually forming an equal low relative to this low, So if we're to break, retest, a failed retest, we probably go all the way down to this 2080 level, because that's where the next level of support lies. And that's probably where the next put support will move down to if the options market and the bulls don't really do something like here right now. That being said, the place to be is definitely the large caps. You can see the S&P 500 only down 0.07, the Nasdaq 100 down 0.06, the IWM mid caps down the most, the RSP as well. So the market is definitely looking at the larger components of the market, these higher quality components of the market to keep their money safe, as well as, shifting out of higher beta, lower quality names, and also looking at stuff like gold up 0.47%. And relatively speaking, that's like a full percentage point worth of alpha when you look at something like the IWM or the RSP, relatively speaking, or just under 100 basis points of alpha. And stuff like Bitcoin, high beta, just people don't want anything to do with it. Bonds not looking that great. All in all, guys, I still think we are going to go high into 2025, and this should be an opportunity to buy the dip. However, price action right now is looking a little bit ugly. The S&P 500 back in that green territory, but if we don't hold this position right here, and we start to break some of these put support levels, especially in stuff like the IWM, the Russell 2000, or the NASDAQ 100, we can definitely see extended sell side to levels that would be maybe 2 to 3% from where we are right now. If we actually take a measured move again from the NASDAQ to the next lower low, we're looking at about a 3.8 as much as 4% pullback to the next key support zone here for the NASDAQ 100. So very crucial for bulls to go ahead, hold these levels that we're seeing right here, because if they don't, we're going to see some pretty ugly sell side. That being said, this is constructive. This is constructive. This is a lower low. We haven't broken the put support. In the NASDAQ 100, it's looking like it's holding that put support line, and in the Russell 2000 as well. Very similar thing. So as long as we can hold these put support levels, I do think this could be an opportunity for us to get long. But let's just get through this week. What I would do if I were you, I would just start dollar cost averaging into the ETFs you like, into the names you like. And I still like the same names. I haven't diverged from that. I do like PayPal. I still like PayPal. PayPal is actually up 1.5% here today. So outperforming the broader market, outperforming the S&P 500. You love to see that. You could see up 1.5%. A name I want to get back into is Paycom. Now, Paycom is actually down 1.22%. So very, very ugly price action. I'm looking to get back into this name. I think a good place would probably be the 189 level, but I think anything below the 200 mark, very, very constructive for something like Paycom. My fair value for the stock is about 218, 219, 220. So, at the 200 level, you're looking at 10% below fair value. You love to see that. Another name that I like is actually PEXA Group, ticker PXA. Now, they appointed a new CEO. The stock rallied 10% on that news. We actually did see a little bit of selling here. I think we're just going to, digest some of these gains, and then we're going to continue to move upward for PEXA. But that really depends on what market momentum is going to look like right now. Yesterday, the stock was down 2.4%, equaling what the S&P 500 did. So the stock, I think PEXA looking really, really poised to go higher, probably back to those highs at $15 in 2025. A name I've been looking at but haven't pulled the trigger just yet is Uber Technologies, down 1.65%. I still like Uber. I like the name. I like the stock. I'm still trying to quantify what autonomous vehicles is going to look like for Uber going forward. And then a name I also do like, if you're going to buy a Mag 7 name, I do like Alphabet, up 0.13% today, actually outperforming the broader market only just. I do like Alphabet. I think fair value for this stock is very close again to that 215 mark, now at 188. Great value right here. Still trading at 23 times forward earnings. Extremely cheap for one of the greatest businesses on earth, and not just a single business. Google is a group of stellar businesses. So those are the individual names I like. And then the ETFs I do like, guys, it's stuff like the NASDAQ 100, the S&P 500, the RSP. These are names I like. Ticker MOAT. I do like QSML, small cap quality. So those are the ETFs. Those are individual names that you should look at to buy the dip into 2025. Anything that's tech related, anything that's finance related. I also do like the healthcare sector for 2025. I think those stocks will do very, very well into the next year. So guys, take the volatility we're seeing right now as an opportunity to get into the market, because we will go high into 2025. We just got positive GDP revisions, great initial jobless claims data. Existing home sales data was really good. The economy is good. The consumer's hanging in there. Buy this dip, guys. You want to buy the fear, and hopefully the market can pull back some more. Hopefully we can get a very solid pullback in the S&P 500. We can get in at lower levels, and then we can just generate more money in the future based on our capital value. So buy the dip, don't trip. And let's talk about sentiment, guys. The fear and greed index officially here in the fear zone. And that was after the shenanigans we got in the market yesterday. Just a couple of days ago, we were sitting very pretty between neutral right here and greed. We now have moved into the fear zone, closer to the extreme fear zone, and we could actually get there if we see a continuation of the events we've seen in the last couple of days. So guys, we are in a period of heightened volatility, so do be prepared for some heavy down days. But at the end of the day, volatility is the price you pay for excess returns in the market. And when you look at it broadly, volatility in 2024 has been virtually non-existent. This is large down days in the S&P 500, 1%, 2%, and 3% down days, and we've had 17 in total. This compares to last year where we had 28 large down days. Now the year's not over, and 63 in 2022. We've only had 13 1% down days or more in 2024, 4 2% down days. So there's been a clear lack of volatility throughout 2024. And so to see the volatility we're seeing right now, to see a bit of a market pullback, it's actually to be expected, all things considered. And the reason why we're pulling back, guys, actually has to do with earnings visibility that pertains to the macro, the Fed, rate cuts, and the overall market environment we're in. You could see that the market has clearly priced in a pullback. This is earnings EPS revisions for 2025, where we think earnings are going to be. And we've seen a clear pullback in earnings for 2025. And the reason why we've seen a dramatic revision in earnings has to do with the overall inflation picture and where the Fed actually pegs the Fed funds into 2025. Now, the biggest input cost when you're looking at valuation is something called a WACC, the weighted average cost of capital, right? If we see a materially higher Fed funds into 2025 than what was expected just in September, we have to adjust the WACC, the weighted average cost of capital, in all valuation models. And because money is worth more today than it is tomorrow, we need to appropriately adjust valuations, price in these new expectations. And in today's market, that simply means a market pullback to re-rate price. Coupled with the fear, uncertainty, and doubt that arises with monetary policy changes, you're going to see capital flight away from risk assets into safe havens. And it all pertains to, again, the Fed interest rate policy. And the reason why we're having this higher cost of capital is simply because they see PCE and inflation projections higher than what was anticipated. And it all comes back to the macro. The reason why we're seeing high inflation numbers is simply because the US economy is just so strong. This is the zero line, and pretty much above the zero line, we're seeing upside to economic surprises. Below the zero line, we're seeing negative surprises to economic data. And pretty much for most of this year, we've seen upside surprises. Yes, we have seen a little bit of a pullback in the last couple of weeks, but net, we've seen upside surprises to the economic data in the US, and that has led to a materially higher point of inflation. And the market recognizes, and the FOMC recognizes this. You could see a risks to core PCE inflation. You can see a risks to core PCE inflation. The September projections saw 16 participants view PCE as broadly balanced. Now they see PCE as weighted to the upside, with 0 members seeing PCE being weighted to the downside. This is also true for the core figure above, and uncertainty about PCE inflation ticked up in a very big way as well. So all things considered, higher inflation expectations because of a stronger macro backdrop means that we actually are going to see a higher cost of capital next year, higher Fed funds, which is going to lead to earnings being revised to the downside, and potentially earnings not being as strong. And because earnings pertain to valuation, valuation pertains to market momentum. That is why we're seeing stocks pull back in the way they are. But when you look at the macro in aggregate, things look very robust. GDP at 3.2%. We saw an uptick from yesterday. This is the Fed's Q4 GDP estimate. The labor market is at full employment, sitting at a 4.2% unemployment rate. Very, very strong. This is what you want to see, particularly in the market environment that we're in. We also see manufacturing output, the composite PMI, at the 56 range, the highest in the last 3 years. So economic output continues to expand and expand in a big way. And when you actually look at the consumer, for most of this year, the Redbook index has been above the 2.8% level. So the consumer has jobs, they have money, the economy is roaring, guys. At the end of the day, in this market environment, any volatility we get in stocks, you want to buy that because things just look really, really good right now. Now, we could pull back further. There could be relief rallies for sure. We could go down as much as 15%. That is something I was penciling into my forecasts closer to the inauguration day, but it looks like we're going to see that volatility now in the near term. But guys, get cash ready because a huge dip buying opportunity will come and we will be higher 12 months from now. And then looking at data tomorrow, guys, we have a big inflation print, something that we want to see. Now, looking at the core and headline month-over-month figures, we want to see 0.3 in both of them and then a 2.5% year-over-year PCE value. We also want to see University of Michigan sentiment at 74. And then if we actually look at the income outlays, right, this is essentially consumer spending. and how much money the consumer is making, we want to see month over month increases of 0.4 and 0.5. The higher, the better. That could affect the inflation picture, but what we really want to see is this core PCE number come in at 0.3%. This is what the Fed really watch. PCE is the Fed's preferred gauge of inflation, so we want to see this number right here come in at 0.3. If it's hot, it's not going to be good for the market. But if it's cool, that could really ease some of the angst in the market, particularly with the rate cut we got and what that's going to look like into 2025. And then looking at earnings, guys, tomorrow we just have Carnival Corp, Winnebago, two consumer stocks. We'll see what they look like. And they're going to give us visibility for earnings into next week's data. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.